In the modern digital economy, the traditional concept of a single income stream is rapidly disappearing. Millions of people across the United Kingdom and beyond are now participating in what is known as the side hustle revolution. Whether it is through digital marketplaces, short-term rentals, or specialized freelance services, the flow of money has become more fragmented than ever before. However, as the ways we earn money evolve, so do the methods used by tax authorities to track it. There is a widespread and dangerous misconception that side income, especially when earned through online platforms or in cash, remains invisible to Her Majesty's Revenue and Customs, HMRC. Many believe that as long as the amounts are relatively small or kept within digital wallets, they fall under the radar. This video is designed to dismantle that myth and explain the sheer scale of the surveillance and data sharing network that HMRC now operates. We will explore the sophisticated technological infrastructure that makes tax evasion in the modern era almost impossible. To understand how HMRC operates today, you must first understand Connect. This is not just a database, it is a highly advanced analytical supercomputer that serves as the central brain of the UK's tax enforcement. Since its inception, HMRC has invested hundreds of millions of pounds into this system to ensure that no financial transaction goes unrecorded. Connect works by pulling in billions of data points from over 30 different sources. It integrates information from the Department for Work and Pensions, the DVLA, the Land Registry, and even the UK Border Agency. The power of this system lies in its ability to perform social network analysis. It doesn't just look at you as an individual, it looks at your entire ecosystem. It identifies links between addresses, business partners, family members, and bank accounts. The most effective feature of Connect is lifestyle modeling. The system calculates an estimated cost of living based on your known assets, such as the car you drive, the house you live in, and the holidays you take. If your declared income on your tax return does not align with the mathematical reality of your lifestyle, the system automatically flags you for an intervention. It is a silent, 24/7 auditor that never sleeps, constantly cross-referencing your digital footprint against your tax filings. The landscape of side income changed fundamentally on the 1st of January 2024. This date marked the implementation of the OECD's new reporting rules for digital platforms. This was a global shift toward total transparency, specifically targeting the gig economy and online sellers. Under these new regulations, digital platforms are no longer just intermediaries. They are now extensions of the tax office. Platforms involving the sale of goods, the provision of personal services, or the rental of property are now legally mandated to collect and verify information about their users' earnings. This data, including your name, address, date of birth, and total annual earnings, is sent directly to HMRC every year. There is no longer a need for HMRC to manually request information on specific individuals. The data flow is now automated and standardized. If your activity on a platform exceeds the reporting threshold, typically 30 transactions or a specific monetary value, your financial profile is shared by default. This covers everything from freelance portals to holiday rental sites and second-hand marketplaces. The anonymity of the internet has been replaced by a direct digital pipeline to the tax authorities. If you think that keeping your money in a separate bank account or a digital wallet provides a layer of protection, you are operating on outdated information. The banking sector is now more integrated with tax authorities than at any point in history. Anti-money laundering (AML) and Know Your Customer (KYC) laws have turned financial institutions into active monitors of your wealth. HMRC receives automatic bank feeds that detail interest earned on all accounts. But beyond interest, banks use sophisticated algorithms to detect patterns of undisclosed trading. For example, if a personal account receives frequent, small payments from various individuals throughout the month, the bank's internal systems flag this as business activity. This information is shared with HMRC under suspicious activity reporting requirements. Furthermore, the reach of HMRC extends far beyond the borders of the United Kingdom. Through the Common Reporting Standard, CRS, over 100 countries now participate in an automatic exchange of financial information. If a UK resident holds an account in a participating foreign jurisdiction, that data is shared back with HMRC. The concept of offshore as a place to hide income is effectively dead. Transparency is now the global standard, and digital wallets like PayPal, Wise, and Payoneer are fully compliant with these reporting standards. While the technology is formidable, HMRC also relies on human intelligence and the public's digital footprint. The tax fraud hotline remains one of the most significant sources of investigations. Every year, tens of thousands of reports are filed by members of the public. These reports often come from former employees, disgruntled business associates, or even neighbors who notice a discrepancy between a person's visible wealth and their professional status. In addition to whistleblowers, HMRC now employs specialized teams to monitor social media platforms. In an age where people frequently broadcast their successes, social media has become a goldmine for tax investigators. If an individual claims to have no income but frequently posts photos of luxury purchases, high-end travel, or expensive lifestyle upgrades, this evidence can be used to justify a formal inquiry. Your digital presence is a public record, and HMRC uses it to build a narrative of your financial health that can be used to challenge your official tax declarations. The conclusion is clear. The net is closing on undisclosed side income. Between the Connect supercomputer, automated reporting from digital platforms, global banking transparency, and social media monitoring, there is virtually no place left to hide. The risks of non-disclosure are far greater than the cost of the tax itself. HMRC has the power to look back up to 20 years, apply 100% penalties, and even seek criminal prosecution in cases of deliberate evasion. However, being compliant does not mean losing all your profits. By registering for self-assessment and declaring your income, you gain the ability to claim legitimate business expenses, utilize the £1,000 trading allowance, and manage your tax liability through legal avenues. Transparency provides security. It ensures that your side hustle can grow into a sustainable business without the constant threat of a life-changing audit. Now is the time to review your records and ensure that your financial house is in order.